Today's episode is brought to you by Mazars.
SoundCartel.
Well, inflation has well and truly arrived, and the Reserve Bank has moved interest rates to try to rein it in. But will continued rate hikes lead to a recession? From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. Melbourne University economics professor Neville accuses the RBA of being irresponsible for promising not to increase rates, but then doing so. He says inflationary pressures are external, so now the bank needs to take its foot off the brake to avoid a recession. Neville starts by explaining the impact of recent Reserve Bank pronouncements to Jeff Waters.
As we've been saying for not months but years, the RBA promise of no interest rate increases until 2024 at the earliest was untenable, irresponsible, and probably the most dangerous policy pronouncement ever, and I'm in print saying that. So we know that's happened, and if we just look back to it, the promise was first made on early November 2020, believe it or not, and it lured borrowers to pay more, economists, except a few, to be trapped into promulgating this message and extending their forecasts, and exactly the same economists who are now saying, oh yes, we see a rate rise of 0.2 or 0.5 or so on coming up. The economic effects of this are, of course, to dash expectations, cause people to think, well, can you trust the Reserve Bank in anything it says? And strangely enough, I believe you can. I believe the scenario that they're bent on is the one that they will do because they are totally impervious to listening to anything else.
So what is that scenario?
That is, after the three rises in May, June and July, further rises into next year towards 2 or 2.5. But look, this is a rate that determines every other rate, and it's a rate no one pays. It basically means if you were paying on housing loans 3.5 to 4, you'll be paying 7 to 7.5 by the middle of 2023. And prime business loans, if they were 4 to 5, around about the 8. These are still low by historical standards. In my view, they don't need to do much more. Rates need to be resuscitated from the low point where the bank supported JobKeeper and the other measures that were necessary during the worst of the COVID restrictions. We still have COVID, but politicians have run for cover, ditched their health advisors, and taken great risks, as you see in countries like Britain.
You know, Mazars has been a long-time supporter of SoundCartel, and now they're helping us bring you this podcast. To find out how Mazars can support your business, visit mazars.com.au. That's mazars.com.au.
So, assuming that the RBA now does what it says it's going to do, and we see rates of just above 2% in the new year, considering that the difference now and when we had higher rates in history is that people have borrowed more now, they're burdened by debt to a higher degree, what economic and business effects are we going to see?
First of all, Jeff, people will have to pay more on their non-fixed mortgages. There'll be spending curbs. Stock market, I think, has factored most of this in. I don't see it going down much more. Housing markets can only slip. My numbers are that after 22% median climb in calendar 21 in Sydney and 18 up for housing median prices in Melbourne for 2021, a drop of about 9% for Sydney and 5 to 6% for Melbourne over the financial year we've started, 2022-2023.
Well, at least that's a lot more optimistic than some people are saying.
Yes, and that's still putting those prices higher than they were before early 2021. Now, the recession business, which is 2 consecutive quarters of real national production GDP, I say this. If the bank stops now and listens to what more and more economists, independent economists, are saying to them, that raising interest rates to stop the type of inflation we've got is absolutely nonsense and stops now, then recession won't happen. If the bank keeps going, then 50% chance of a recession, or as fellow economists like Alan Kohler are saying, the recession will be created by the bank needlessly.
Just on that, you said this sort of inflation. What do you mean by that?
We call it stagflation, Jeff, and it's code for increases in inflation that come on the supply side or from the rest of the world, which are not treatable by quelling overall spending in the economy, either through the budget or the only thing left for the Reserve Bank these days, it used to have other controls, is raising interest rates. In addition to those impacts on housing and stock markets, there's, of course, the overall impact and specific impact in economic activity.
So what about economic activity overall and also in specific sectors?
Well, overall activity, I think, is going to go about 0 instead of 2% growth after all of this, and maybe a slight positive. But let's go to specific sectors. Agriculture is split between those that are really damaged by floods and by high fertiliser prices and other input prices.
Energy costs.
Indeed, and energy costs, which everybody's got. And some of it, on the other side, is really doing extremely well with some of the world grain prices and so on. Construction and house building. Rise and fall clauses tragically have gone. Fixed price contracts are killing builders unless they can make their money out of variations, and people are getting smarter on that. Supply shortages, labour shortages, and the fixed price contracts, really serious problems there. Retail, significant supply problems with labour and people not coming back. Recession chance, I've said, is 0 if the bank stops now and 50% if the bank keeps going. So that's a quick look at the diversity of conditions within the economy. Economic activity dulled, but mostly unlikely to be a recession.
So given all of that, what can I do as a small business owner? What are the practical steps I can take?
I'm going to do another thing first. People ask me, what can you do about inflation? This type of stagflation, time is the only cure. If the things that are really causing the jump from the 1.1 to the 5.1 to which the bank reacted, first of all in May, then they cannot do anything about Vladimir Putin, droughts and floods, world global prices, or the damage done by the Americans and the Europeans raising interest rates for the same needless reason. Now, to individual businesses and persons, I do have a practical list. First of all, to the extent that you can make any difference through your industry associations, your local members, and by your own agitation, higher migration, stopping interest rates going any further, putting sense into further wage decisions to say enough is enough, support from the state and the feds for businesses. These are all direct actions that you as businesses can take. Next point, invoke all the family and friend labour you can get, including people out of retirement. Share this situation and your position with it and what you're doing with your banks and your financiers. Consider loan revisions, but be careful. Get all of the contractual terms. If you're in the building and construction industry, try to get rid of these damaging fixed price contracts that were done for another age and are a killer, and highlight the specific features of your offerings, your products, your services to the market. These are all practical things you can do in this environment, and it was never more important to do them.
That was Neville Norman, Professor of Economics at Melbourne University. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow @BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast.
SoundCartel.
This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.